Have you ever wondered how trading the gold and silver ratio can benefit your investment portfolio? Well, you're about to find out. In the world of trading, there's an intriguing concept that has been used for centuries: the gold and silver ratio. This ratio, simply put, is the quantity of silver it takes to purchase 1 ounce of gold. It's a figure that traders and investors have used as a barometer for market conditions since ancient times. From the era of the Byzantine Empire, where the ratio was set at 12:1, to the modern-day fluctuations, this trading strategy has been a fascinating journey. And it's not just about history, it's about understanding market trends, predicting potential shifts, and making informed decisions to maximize returns. In the next few minutes, you will learn how to utilize this trading strategy to your advantage. Before we dive into trading, it's vital to understand what the gold-to-silver ratio is. The gold-to-silver ratio is a simple concept that represents the number of silver ounces it takes to purchase 1 ounce of gold. It's a measure that investors and traders use to gauge the relative value of these two precious metals. To calculate the ratio, you divide the current gold price by the current silver price. It's a straightforward calculation, but the value it holds can offer deep insights into the market dynamics of these two metals. Now, let's talk about the historical average of this ratio. Over the past century, the gold-to-silver ratio has averaged around 50:1. That means, on average, it has taken 50 ounces of silver to purchase 1 ounce of gold. But here's where it gets interesting. This ratio fluctuates. Sometimes it's higher, sometimes it's lower. And these fluctuations can hint at shifts in the market sentiment towards these two metals. For instance, a high ratio suggests that silver is undervalued relative to gold. Conversely, a low ratio might indicate that gold is undervalued relative to silver. It's these movements in the ratio that savvy traders pay attention to. However, it's essential to remember that while the ratio can provide valuable insights, it's not a standalone tool. Like many aspects of trading, it's most effective when used in conjunction with other indicators and market analyses. The gold-to-silver ratio is more than just a number. It's a lens through which traders can view the relative values of gold and silver, helping them make informed decisions based on the market's current state. It's a testament to the interconnectedness of these two metals, and the markets they inhabit. Now that we have a grasp on what the gold-to-silver ratio is, let's move forward to how you can use this knowledge in trading. The gold-to-silver ratio isn't just a random number, it holds relevance in the world of trading. Now let's unravel the mystery behind this statement. In the trading world, we're always looking for indicators, those little clues that guide us when to buy and when to sell. The gold-to-silver ratio serves as one such indicator. It measures how many ounces of silver it takes to purchase 1 ounce of gold. When the ratio is high, it indicates that silver is undervalued compared to gold, which could be a sign to buy silver. Conversely, when the ratio is low, it suggests that gold is undervalued, signaling that it might be a good time to buy gold. But how do we know when the ratio is high or low? This is where the concept of mean reversion comes into play. Mean reversion is a financial theory suggesting that asset prices and returns eventually revert back to their long-term mean or average. This concept is key in understanding and predicting price movements. For the gold-to-silver ratio, the long-term average has hovered around the mid-50s. So if the ratio shoots up to, say, 80, it's significantly above the mean, indicating that silver is undervalued. Traders would then expect the ratio to revert back to its mean, and might consider this a good time to buy silver. On the flip side, if the ratio drops to around 30, it's significantly below the mean, hinting that gold is undervalued, and traders might see this as a signal to buy gold. Of course, like any indicator, the gold-to-silver ratio isn't foolproof. It's just one tool in a trader's arsenal, and it's most effective when used in conjunction with other indicators and market analysis techniques. With the understanding of the ratio's relevance, we can now delve into the practical steps of trading. So, stay tuned as we navigate the exciting world of gold and silver ratio trading together. Trading the gold-to-silver ratio may seem complex, but with these steps it becomes a lot simpler. So let's dive right in. Step 1. Understand the ratio. The gold-to-silver ratio is simply the amount of silver it takes to purchase 1 ounce of gold. If the ratio is 75:1, it means you need 75 ounces of silver to buy 1 ounce of gold. This ratio is crucial in determining whether gold or silver is undervalued or overvalued. Step 2. Track the ratio. Constantly keep an eye on the gold-to-silver ratio. You can find this information on various financial websites or through your brokerage account. The ratio fluctuates over time due to supply and demand, economic data, and geopolitical events. A high ratio indicates that silver is undervalued relative to gold, and a low ratio shows that gold is undervalued relative to silver. Step 3. Decide when to buy or sell. If the ratio is high and you believe it will decrease, it might be a good time to buy silver. When the ratio decreases, silver tends to outperform gold. Conversely, if the ratio is low and you think it will increase, it might be a good time to buy gold. When the ratio increases, gold typically outperforms silver. Step 4. Execute your trade. Once you've made your decision, it's time to execute your trade. You can do this by buying physical gold or silver, purchasing shares of a gold or silver ETF, or trading futures contracts. Just remember, every investment comes with risks. Step 5. Manage your risk. It's crucial to have a risk management strategy in place when trading the gold to silver ratio. This could involve setting stop-loss orders to limit your losses if the market moves against you, or taking profits when the ratio reaches your target level. Step 6. Review and learn. After executing your trade, take some time to review and learn from your actions. Did the ratio move as expected? What could you have done differently? This step is critical for improving your trading strategy and success in the future. Step 7. Stay informed. Finally, stay informed about the financial markets and global events that could impact the gold to silver ratio. This includes economic data releases, central bank decisions, geopolitical events, and more. Staying informed will help you make better trading decisions and potentially increase your profits. Remember, trading the gold to silver ratio is not a guaranteed way to make money. It involves substantial risk and requires a comprehensive understanding of the financial markets. But with careful planning, diligent observation, and disciplined execution, it can be a valuable tool in your trading strategy. These steps provide a guide to start your journey in gold and silver ratio trading. We've covered a lot of ground, so let's take a moment to revisit the key points. In this journey through the fascinating terrain of gold and silver ratio trading, we've unraveled some intriguing concepts. We started by delving into the world of this unique trading strategy, highlighting its distinctiveness and the potential it offers to those who dare to tread its path. We then moved on to the crux of our discussion, the gold to silver ratio itself. This is the measure of how many ounces of silver it takes to purchase 1 ounce of gold at any given moment. It's a dynamic figure, constantly changing with the ebb and flow of the market, and it's this fluctuation that traders seek to capitalize on. We've also discussed the vital importance of this ratio in trading. It's not just a mere number, but a barometer of the market sentiment, a reflection of the interplay between supply and demand. When the ratio is high, it typically means gold is overvalued or silver is undervalued, and vice versa. Traders use this knowledge to make informed decisions about when to buy or sell. And finally, we walked through a step-by-step guide on how to engage in gold and silver ratio trading. We highlighted the importance of monitoring the ratio's trend, setting up a trading plan, and executing trades based on the plan. It's a methodical process that requires patience, discipline, and a keen understanding of the market. The world of gold and silver ratio trading is an engaging one, filled with opportunities and challenges. It's not for the faint-hearted, but for those who are ready to delve deep, learn, and adapt. It can be a rewarding venture. Remember, the market is a vast ocean, and the gold to silver ratio is one of the many navigational tools at your disposal. Understanding its nuances, its swings, and its implications can be your compass in this ocean. The world of gold and silver ratio trading awaits you. Remember, knowledge is power, and understanding the market is your best tool for success.